Hey there. Ever been hit with taxes you had to pay to another state that you don't even live in? You're scratching your head or calling your tax pro names under your breath as you watch more of your income get stripped away? My son learned that lesson the hard way when he took a summer job in another state and watched a chunk of every paycheck disappear. He's experiencing it again this year, this time in an even higher tax state. But here's the thing, he earned that money there, boots on the ground. Labor performed within the state's borders. That's called physical nexus. And physical nexus is the easy one to understand. There's also something called economic nexus, born out of a landmark Supreme Court decision that overturned the gold standard that had protected businesses from out-of-state obligations for decades. I'm Bill Bourbonnais, and welcome to Three Things Thursday. Today, we're diving into three things to know about Nexus and what it can do to your taxes. Thing number one, physical nexus. You know it when you see it, but it surprises even real estate investors. Physical nexus is exactly what it sounds like. You have a physical presence in a state, you have employees working there, an office, a warehouse, or you're personally performing services there, and that state has the right to tax the income connected to that activity. And my son working in another state is the simple version. A less obvious version, you fly to New York or California for a week to work at your company's corporate headquarters, and suddenly your W-2 shows taxable income allocated to that state. You didn't move there. You were there for a week, but you performed services within their borders and they want their piece. Now here's the one that surprises real estate investors. If you own real estate rental property in another state, you have physical nexus within that state. The property itself is the physical presence. That state has the right to tax income connected to that property. During the rental years, this often flies under the radar if the property is throwing off losses, which it often is, especially with depreciation in the loop. There may be little or no taxable income to report there anyway, but when that property sells, that's when it bites. Depreciation recapture and capital gain on the sale are sourced to the state where the property sits, not to where you live, where the property is. Investors who assumed their home state return was the whole story have received some very unpleasant surprises at closing and after. Physical nexus follows the property and the activity, where you work, where your property is, where your people are. And for real estate investors, the sale is where it shows up. Thing number two, economic nexus. The Wayfair decision opened a door that states ran through. For most of modern tax history, states were limited in what they could tax when the business had no physical presence in that state. The gold standard came from a Supreme Court case in 1992 called the Quill Corporation versus North Dakota. The court held that a business had to have physical nexus, physical presence in a state before that state could require to collect sales tax. No physical presence, no obligation. That case, that decision held for 26 years. In 2018, the Supreme Court overturned Quill in South Dakota versus Wayfair. The court said physical presence was no longer the constitutional requirement for sales tax nexus. Economic activity alone, selling enough into a state, having enough transactions, could be sufficient. States didn't wait. They immediately began applying economic nexus logic beyond sales tax, pushing into income tax as well. If your business generates enough revenue from customers in a state or has enough economic activity there, an increasing number of states are asserting income tax nexus even without a single employee or square foot of space within their borders. The specific thresholds vary by state and they change, but that's not the point. The point is the physical presence shield that businesses relied on for a generation is gone for sales tax and is eroding fast for income tax. Service businesses and digital businesses are especially exposed. There's a federal statute, Public Law 86-272, that provides some limited protection for businesses that only solicit orders for tangible personal property. It does not protect service providers. It does not protect what most business owners in this audience actually do. Quill gave businesses a physical presence shield for 26 years. Wayfair removed it. States are now asserting income tax nexus based on economic activity alone, and they're not waiting to be asked. Thing number 3, the nexus trigger that nobody sees coming, just one remote employee. If Wayfair is the nexus story most people haven't heard, this is the one that blindsides business owners who thought they were doing everything right. You have one employee. She's great. She asked if she could work remotely, and you said yes because it didn't seem like a big deal. And then she moved to Colorado. You now have a payroll factor in Colorado. Depending on how Colorado defines nexus, and most states define it broadly, you may now have income tax nexus in Colorado. Not because you decided to operate there, because you let somebody work from home. This is not a hypothetical. This is what happened to thousands of businesses after the world went virtual. Remote work exploded. State revenue departments did not stand down. They saw payroll appearing in states where businesses had never filed before, and they started asking questions. Many states use what's called factor-based nexus. If you have payroll, property, or sales above a threshold in the state, nexus may exist regardless of your physical presence in the traditional sense. One remote employee can clear that bar. Some states have a doctrine called convenience of the employer. If an employee works remotely for their own convenience rather than because the employer required it, several states will still tax that income as if the work was performed in the employer's state. New York is probably one of the most aggressive on this. It creates double taxation exposure for the employee and compliance obligations for the employer. The practical implication? Before you approve a remote work arrangement in a new state, nexus is a conversation that has to happen before the first paycheck is issued. After the fact, it's a much harder problem. Here's the takeaway. You don't have to intend to operate in a state to have obligations there. One employee, one property, enough revenue, and the state may already consider you a taxpayer. Physical nexus follows activity, where you work, where your people are, where your property sits. Economic nexus follows revenue, and states have been aggressive since Wayfair removed the physical presence shield. And the remote work shift created nexus exposure that most businesses have never mapped. If you have employees in multiple states, own real estate outside your home state, or your customers span state lines, this is a conversation worth having before a state starts it for you. If distinctions like these are helpful, 3 Things Thursday drops every week. Hit subscribe or follow so you don't miss the next one. And if any of this applies to your situation, that's a conversation worth having before you move. You can find us at bourbonnetax.com. Thanks a lot and have a great day.